Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to discuss Canada's latest inflation print. The main takeaway for us here at IceCap was we think inflation is going to rebound in the spring and into the summer. And this will very much complicate life for the BOC and of course the millions of Canadians set to renew their mortgages. But first, let's dissect the release. Headline inflation actually came in as expected, rising 0.1% in January. This lifted the year-on-year figure to 1.9%, up from 1.8% in December. Remember, the BOC's inflation control target is 2% plus or minus 1%. That means headline inflation is exactly where the BOC wants it. And indeed, over the past several months, the Bank of Canada and some government officials have been congratulating themselves for this incredible accomplishment. But I will remind the viewer that prices are still well above pre-COVID levels. Inflation is not, in fact, transitory. Now let's look at the subcomponents and what's going on and why, again, we think inflation will pop this spring. This is a chart of the monthly changes to the different CPI components. And as you can see at the top of the chart, higher energy prices, driven by gasoline and natural gas, drove much of the change in January. At the bottom of the chart is alcohol, food, and recreation, which continue to fall under the weight of the tax holiday. More on that later. What I wanted to flag was the BOC's three preferred measures of core inflation. They're preferred because they are measures of central tendency for inflation that do a good job excluding and accounting for items in the consumer basket that whip about, high and low, from month to month, which distort the headline figures. These measures drill down to the core of inflation, pardon the pun, and as you can see, they have stopped falling. In fact, this month, 2 of the 3 measures came in higher than expected. And over the next few slides, I'll explain why I think they're set to head even higher. The first reason is rather boring, and by that, I mean simple math. If tax cuts reduce prices and thus reduced inflation, then it stands to reason that reinstating those taxes will lift inflation. It sounds straightforward because it is, and you'll remember that we were not a fan of this tax holiday when it was announced. Number 1, it's regressive. Rich people benefit more. And number 2, the government had to borrow to pay for the gimmick. In the same vein as the reversal of the GST holiday is the April Fool's carbon tax increase, which will increase the price of gasoline, diesel, and natural gas. Higher prices for fuel will have a direct impact on inflation, literally increasing several of the subcomponents of the consumer basket, and it will have indirect impacts as businesses pass along price hikes for inputs to products and services that they sell to consumers. So why do we care? Other than the fact that we think it's a dumb and rather ineffectual policy, it's because of the timing. A look at the IceCap inflation model really makes this clear. This model is based on core producer prices which exclude energy. And as we can see, those rising producer prices eventually flow through with a lag to consumer prices. Note that this rise is occurring before the reversal of the GST break and before the carbon tax hike, which will of course affect producer prices and thus flow through to consumer prices. As always, I'll warn you that models should be viewed with a healthy bit of skepticism, but one cannot ignore them either. The reality is that raw materials and other input prices are rising, and this will impact consumer prices in one way or another. The reason inflation is so important is that it affects interest rate expectations for the Bank of Canada and household mortgage rates. That's what those 4 little dots are on the chart. Interest rate expectations based on overnight index swaps, which are instruments people use to bet on the direction of interest rates going forward. As you can see, they're basically flat, which translates to between 4.5 and about 5% for a 5-year conventional mortgage. But these expectations are not static. They change to reflect the current economic landscape and growing risks, like tariffs. Nevertheless, they remain our best guess on the path of mortgage rates. And to this, they say there's no respite. This is critical because according to a CMHC report from late last year, about 1.2 million mortgages are due to come up for renewal in 2025. Most of these will experience higher interest rates than when their term began. 85% of these mortgages were taken out when the Bank of Canada's rate was at or below 1%. And according to WAWA, a personal finance encyclopedia, an excellent resource for those interested in the Canadian housing market, mortgage renewals are set to rise sharply in 2025 and 2026, with increases of approximately 57% and 100% respectively compared to last year. These increased payments will, at the margin, lift delinquencies and weigh on consumption. So before we sign off today, I just want to highlight where we might be wrong. And for us, the big risk to our view is rents. As you know, rents shot up with the massive amount of population growth that we've seen over the last few years, and that is starting to unwind. Across the country, rents have collapsed. In fact, the CPI component is grossly overestimating what's happening on the ground. If those rental prices continue to fall, it's possible that they'll drag on headline inflation. We shall see. So that's a wrap on this week's episode. Thanks again for listening. Please like, subscribe, and follow for more. It helps us with the algos. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.